Okay, let's take a look at what's happening, what else is happening in the markets. And for that, we're joined by Art Hogan, Chief Market Strategist at B. Riley Wealth. Art, thank you very much for joining us.
Roger, thanks so much for having me.
An interesting day today. A little bit, I was looking at the TSX. I think every sector was in the red right now except for one.
Yeah, we're not doing that much better down here. The S&P 500 only has 2 of their 11 sectors in the positive territory. And the interesting catalyst really is that we've come pretty far pretty fast. I think that's one piece of the puzzle. There's been ongoing questioning about the circular nature of some of the CapEx spending and artificial intelligence. I think there always will be. But we're, call it 2/3 through earnings reporting season, and that's been a positive, but the reaction function has been very interesting. And another interesting reaction today with Palantir, which came out and beat on the top and bottom line and took their guidance up. But investors get to a place where they just say, how much of this is already priced in? You're talking about a stock that's up some 300% on a year-to-date basis. Clearly one of the artificial intelligence adjacent darlings. And we've seen this time and time again throughout this earnings reporting season, coming in at or near an all-time high. There's just very little you can do to impress even more, given your valuation coming into your report.
And now we keep thinking maybe this is it, but then it keeps getting pushed higher and higher, especially within AI.
Yeah, I think that's always the case. We've unfortunately, too many of us have this muscle memory back to the .com boom and bust and assume that this is going to follow a similar trajectory. But then we have to take a step back and say, well, actually, all of these companies, all of the top 10 mega cap technology companies that are very involved in artificial intelligence, which I believe is in its very early innings, are actually real companies that have real cash flows and have the money to spend on this build out of large language models, and will likely continue to. As a matter of fact, every one of the major players talked about their CapEx and how much they're going to spend over the next 12 months. The problem is, at what valuation can we accept that before we actually start to see some real revenues coming out of this, some return on investment coming out of this? And that's where the sort of line has been drawn in the sand, at least for this earnings reporting season. I don't think that we're anywhere near the end, and I'd also argue that valuations aren't really, for the most part. If you look at Mag 7, the average valuation is about 35 times. If you went back and looked at the 7 largest internet-related companies in 1999, you'd have to, add a 0 to that. You'd be like 150 to 200 times. So it's, the comparisons fall short, but there's always that trepidation that we've come too far too fast at the beginning of a new technology rollout.
Are people starting to look elsewhere? Gold's kind of sitting at about it's kind of flattened a little bit at 4,000, hovering there right now. Where are people looking?
Yeah, gold is another amazing move this year, right? So, that's been one of those diversifiers that's finally worked for the first time in 14 years and has worked over the course of the last couple of years. I think the drivers there are much different than just looking for something else. I think it's, the 3 key drivers are ease of use with ETFs, so you don't have to buy the actual gold and store it somewhere. You've got central banks that have now preferred it for going on 3 years now over treasuries. So, that clearly is another driver. But the momentum players that have, seen this break out of a 45-year inflation-adjusted base and finally making new highs, clearly that's drawn in that cohort. But remember, momentum players get out as fast as they got in. So we got to 4,300 an ounce, and I suspect some of that momentum money still comes out a bit. But I'd love to see it test 3,800 for a new, better entry here.
And they had talked about going for December, the price possibly being 42, even as high as 4,700. Is it looking like it's heading that way still?
Yeah, it depends on which December you're talking about. I don't know if that's going to be this December's business or next, but it certainly seems to have a pretty clear flight path, certainly north of where it is right now, but not without some volatility. It's been unidirectionally higher for a period of time, so this pullback really makes a great deal of sense. And what I would say that likely does is shake out that new cohort of investors that's just playing this for the momentum. And once that settles in, let's call it 38, 3,900, you'll probably see another bounce and a leg up. I don't know if we'll make it this December, but certainly by next Christmas we could be well north of where we are now.
And what about where's oil in all this right now? What are people doing with that? It was over 60. It had a little bit of a little run here for about 4 days. Now it's dropped back down again. What do you see people doing with that?
Yeah, there's so much geopolitical risk around this, and OPEC Plus has done a pretty good job, controlling their outputs. I would say that most of the oil-producing countries in OPEC can't even produce at the current quotas that they've been given. So Saudi Arabia is making up the difference. I think they want to leg out more production slowly as the global economy picks up more demand. But I would say that we've probably seen the bottom in WTI, at least for the next 6 to 12 months, and we'll likely see a move a bit higher. And I think that it's really driven by three things. I think first and foremost, the U.S. production, while growing, is slowing. So we're not seeing that overproduction or that massive increase on a percentage basis of production in the U.S., which is the largest producer. I also think that you've got the ability for China to start coming back in the global economy with more demand for the hydrocarbon. And we know that this artificial intelligence revolution is going to need all of the above when it comes to energy production and electricity production.
And then put all this in a nice little basket. Where do you go? What do you do with it all?
I'll tell you this. I think that we're going to have volatility into the end of the year, into the first part of next year. We just had great earnings coming out of the third quarter, and estimates went higher for the fourth quarter. So I don't think you want to get shaken out of your long-term investment plan because of some of the volatility we see around, especially some of those artificial intelligence names. I think if you have a well-diversified portfolio, you want to stick to that. I think the economic growth for next year looks even better than this year, and we can probably point to some of that economic data as soon as the government reopens.
Okay. On that note, Art, thanks for joining us.
Thank you so much.
Art Hogan is Chief Market Strategist at B. Riley Wealth.